If you've ever been confused by terms like Roth, 401k, traditional, IRA, you've come to the right place. By the end of this video, you'll know what all of those terms mean and more, so stay tuned. Hey there, what's going on guys? My name is Justin Conroy and welcome to another video. If this is your first time here and you want to learn tips, tricks, and hacks related to personal finance, how to build wealth, and how to better manage your money, don't forget to subscribe and hit the notification bell down below so that you don't miss a thing. So let's get right into this. I'm going to put up a diagram and talk through some terminology to clarify some things right off the bat. So the first thing to understand is that there are different types of retirement accounts. The two that I'm showing here are the IRA, which stands for Individual Retirement Account, and the 401k. These are the two most popular types of investment accounts. There are many other types out there, but for this video, I will only talk about IRAs and 401ks. So the level below the types are the subtypes. This is where the common terms like Traditional and Roth fit. This means that if you have an IRA, you can have either a traditional IRA or you can have a Roth IRA. Same goes for the 401k. You can have a traditional 401k, or you can have a Roth 401k. Does that make sense so far? Hopefully that clears up more than half of the confusion already. But let's go ahead and get into some of the details and talk about what each of those means for you. So let's cover these topics one by one. First line is source, and what I'm really getting at here is where do these things come from? So if you're talking about an individual retirement account, that's an IRA, it's your choice to have one. Anyone can get an IRA. Anyone is eligible for an IRA. All you have to do is go open one. But a 401k is a little bit different. Not everyone can have a 401k. Not everyone is eligible for a 401k. A 401k is specifically something that your company offers as a benefit. It's usually part of the benefits package. So if you're working for a company that does not offer a 401k, you probably don't have this option. There are options for 401ks out there for self-employed individuals, but that's beyond the scope of this video. The next line is the yearly contribution limit. So if you're looking at an individual retirement account and you are under 50, in 2019, you can contribute up to $6,000 per year into that account. If you're over 50, you can contribute up to $7,000 to that account. Now 401ks are a little bit different. They allow you to put in a lot more money. So if you're under 50 here in 2019, you can put up to $19,000 into your 401k. And if you're over 50, you can put in up to $25,000 into your 401k. Now keep in mind, this is regardless of whether you have a traditional or a Roth version of these accounts. We'll talk about the specifics of each of those in just a few minutes. When it comes to investment options within your retirement accounts, IRAs typically win out. They usually have a much larger number of options in terms of the funds that you can buy. With 401ks, you are unfortunately limited to the options defined by your company or their benefits package provider. So it's not uncommon, for example, for companies to offer less than 6 or 7 funds for you to choose from, and you're just unfortunately at their mercy in that regard. Now, when it comes to employer matching, 401ks definitely have the potential to win out over IRAs because unfortunately, no employer is going to match contributions into your individual retirement account. But 401k employer matching is actually very common. Over half the companies in the United States do match some sort of 401k contribution. And all this means is that for every percentage of income that you contribute to the 401k, your company is going to contribute the same amount. It really does depend on the company. Some companies don't match at all, but when they do offer, it's something you definitely want to take advantage of. Now, when it comes to income limits, it really depends for an IRA. So we'll talk about that in just a few minutes. It changes whether or not you have a traditional IRA or a Roth IRA. With 401ks, however, there are no income limits to participate. So as long as your company offers a 401k and you want to participate, there should not be any limitations on how much money you can make to participate, either on the bottom end or the top end. Doesn't matter what your income is, you should be able to participate. Required minimum distributions are a little bit different, and this does depend on whether or not you take a traditional IRA, a Roth IRA, a traditional 401k, or a Roth 401k. So we'll talk about that in just a few minutes on the next page. So finally on this page, we have early withdrawal penalties. And there are slight differences to IRAs and 401ks in this regard, but the terminology is a little bit different. So if you have an IRA or a 401k and you are thinking about withdrawing money early for some reason, be sure to check the fine print so that you can be sure that your withdrawal is either deemed qualified or as part of an exception for each of these different types of accounts. So now that we've covered the top part of the diagram and all the differences between an IRA and a 401k, if you're finding value out of this video, do me a favor and go down real quick and hit the thumbs up. It really does help a lot. Now let's go ahead and move on to the traditional versus Roth subtype discussion. So as you can see right off the bat, the differences between Roth and traditional retirement accounts isn't too complicated. So first things first, and by far the largest difference between Roth and traditional subtypes, is the timing and taxes on the contributions. With a traditional retirement account type, contributions happen before income tax is calculated. So this is what's known as pre-tax contribution. This means that you can reduce the amount of income that you claim on your income tax each year by contributing funds into a traditional retirement account. With a Roth retirement account, contributions happen after income tax is calculated. So this is known as a post-tax contribution. This means that when you get paid, the IRS takes their money first, and then you are able to contribute your remaining money into a Roth account. So, as opposed to the traditional retirement account, you cannot deduct the contributions from your income when reporting on your income tax every year. The next biggest difference is how your withdrawals are taxed. For traditional accounts, the IRS will treat your qualified withdrawals as income for the year in which you withdrew the money, and that income gets taxed as such. It doesn't matter if the money you withdraw is considered part of your original contributions or money that was grown through interest. The money is simply treated as income. However, for Roth accounts, as long as your withdrawals are deemed qualified, the IRS will not tax you for the money you withdraw. Technically speaking, you have already paid taxes when you first put the money into the account. This also means that the growth in the account due to compounding interest is also not taxed. Let me say that a little bit different. For a Roth type account, your account's earnings, interest, capital gains, etc. are all tax-free. Now, when it comes to income limits and whether or not you are eligible for these retirement accounts, it's actually pretty straightforward. For traditional type accounts, there are no income limits to participate. So you can make as much money as you want and still have a traditional retirement account. However, Roth accounts have a stipulation, but for the IRA only. So if you want to use your Roth IRA, you can't make more than $203,000 if you are married, or $137,000 if you are single. And that's here in 2019. Now, if you are in this group and you want to use the Roth IRA, there are some loopholes that you can take advantage of under certain circumstances, but that's beyond the scope of this video. Finally, when it comes to the minimum contribution withdrawal age for each of these types of accounts, things get a little bit more complicated. So I'll take this as the opportunity to show you a slightly different diagram and take it from there. So what I've got here is a slightly different diagram showing how all these things break down and which rules apply to which accounts. So let's use this diagram not only as a demonstration of how to use it, but also to talk about that last point. So you start over here on the left, retirement accounts. When you zoom in, you'll see that there are two main branches, one for IRA and one for 401k. And then on each of those branches, you'll see two others, one for traditional, one for Roth. Okay, so there you go for IRA, and down here, same thing, traditional, Roth. So what you can do is use this to figure out what type of account you have or which one you're interested in, and then see all the individual rules for each of those different accounts. So the last one we were talking about was the age at which you are required to take withdrawals from your accounts. Okay, so if you have an IRA and it's a traditional type, your requirement minimum distribution age is 70 and a half. Okay, so be aware of that if you have one of these. If you have a Roth, your requirement minimum distribution age is actually non-existent. So if you have a Roth IRA, you don't ever have to withdraw the money from that account. There are no stipulations on when you actually do that, as long as the owner is alive. Okay. Down here for 401k traditional, we have a requirement minimum distribution. So as long as you're still working, you don't have to withdraw. But if you're not working, you must start withdrawing by the age of 70 and a half. Okay. And the last one, of course, is the Roth 401k. And it is exactly the same as the traditional 401k. As long as you're working, you don't have to pull money out. But as long as you're not working, you have to start by the age of 70 and a half. Okay. So hopefully that's a good example of this diagram and how to use it. I am going to put a link in the description down below for this diagram if you'd like to check it out on your own. So I imagine by now you have several questions like, which one of these should I use? How much money should I put into these accounts? Well, what happens if you have a 401k with your current company, but you decide to leave? Am I going to lose all that money? Well, I really like the Roth IRA, but I think I make too much money. What can I do? I've heard everyone say I should put all my money in a Roth, but is that right? I'll be discussing all of those questions and more in future videos, so don't forget to subscribe and hit the notification bell so that you don't miss them in the future. So with that, if you have any questions, comments, ideas for future videos, please feel free to leave them down below in the comments. I'm doing my best to read and respond to as many as I possibly can. Don't forget to like, subscribe, and hit the bell on your way out. Don't forget to follow me on Instagram and Facebook. As always, thank you for your time and your support. Thank you for watching. Have a good one.